I'm proud to welcome you to the Exceptional Advisor podcast series. Hi, I'm your host, Bob Howell. Whether you're new to our series or have been here since episode 1, thank you for tuning in. The Institute remains the member association of exceptional advisors. We hope this series will help you better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Today, we are proud to introduce a new sponsored series with Delaware Life. Today, our guests are Anders Smith, Vice President and Head of National Sales Consulting at Delaware Life, and Jeng Chiu, Vice President and National Sales Consulting at Delaware Life as well. Welcome, gentlemen, to the podcast.
Thanks. Great to be here, Bob.
Thanks, Bob.
Great to have you. So before we get started, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview? Anders, you can go first.
Sure, Bob. So I've been in this business about 35 years. I spent the first 31 years at MFS and Nuveen, and my last 3 years have been here at Delaware Life. I really spent all that time looking at this industry from all different views. I started on the internal desk. I'm a wholesaler and in national accounts, and then I spent really the large majority of my career really as a practice management and wealth management consultant, helping advisors continue to grow and manage very successful, profitable businesses.
Right. And I should mention too that you hold a number of designations from the Investments and Wealth Institute.
I think I've got the trifecta. So yes, I have earned my CIMA, my CPWA, as well as the RMA designation, and it's been a tremendous experience, a tremendous organization for sure.
Yeah, well, we're grateful for that. Jeng?
Yeah, so thanks, Bob. I've been in the business for about 23 years. My career's basically been divided into 3 parts. The first part, I did a lot of fee-based planning. So I used to write those customized 100-page plans that I always say nobody ever read, but I used to write those and did a lot of Monte Carlo simulation and did different various customized planning. And the second part, I spent doing national accounts. So I did several years. I worked with a couple of major firms and did national accounts and worked with the firms and the companies. And lastly, third part of my career really was spent in advanced planning, talking about tax strategies, talking about estate planning, financial planning in general, and did a lot of client events as well. Probably did over a couple hundred client events. And my background is in accounting and law, and I'm also a CFP designation holder.
Great. We're going to have to work on you to get your CPWA, CIMA, or RMA to catch up with the Anders. Also, before we get going, maybe you could provide a brief overview of Delaware Life.
Sure. So really our mission here at Delaware Life Insurance Company is to deliver what we call pure value for financial professionals and the clients that they serve. And we do that both by the investments and the products that we provide, which are designed with client needs and transparency, but also to provide a level of income certainty for them in retirement and throughout retirement. But it's also about how we support financial professionals through the education and the training that we provide through our Income Planning Institute to help them be more dynamic and effective as they work with clients on income planning needs. And we address topics, around, beyond just the normal things. Things like using the 4% rule or traditional asset allocation, that's not really it today, right? So we try to help them move beyond that and address the really core issues of retirement income planning. And that's what we'd like to talk about over the course of the series of these webinars, the next 6 webinars, including this one that we're going to do. So we're going to highlight those resources and how they fit into the income planning process.
Right. I should reemphasize that this is the first in a 6-part series where we will be looking at tax planning, Social Security, healthcare and Medicare planning, distribution strategies, and even estate planning. So
exactly. Yeah, all of those are key elements. Yep.
So for today, the topic is, you mentioned a second ago, dynamic income planning. Let's start with this question about how does Delaware Life think about this topic?
Yeah, income planning is very dynamic. It has to be very flexible in terms of how you approach it. And really, as I mentioned, moving beyond that conventional wisdom. So many folks get caught up in thinking about using that quote unquote 4% rule, but that we got to remember that was put together in the mid-90s when capital markets were very different. So today that 4% rule likely would not work because of how the capital markets are structured today. So we have to look at different options. We have to look at other ways of providing income beyond systematic withdrawal strategies, et cetera. And it's really a combination of investment planning and insurance planning, right? You have growth as well as guarantees, regardless of what the client's income or asset level may be. They're looking for things like certainty, and obviously it has to be a comprehensive approach that's flexible in nature. A lot of different levers to pull, both as you accumulate assets and where those assets are placed. But then when you start to take distributions, you have to look at, taxable, tax deferred, and tax free, right? And creating different options for clients. So it becomes a very dynamic process, and that's what we promote, and that's what we help advisors understand, because there's a lot of new issues, new competencies that they may not have learned as they've been helping clients through the accumulation stage. That they really need to really get their arms around if they're going to be effective. Because a lot of folks, when they're coming to a financial professional for income planning, when they get to retirement, oftentimes we're seeing that they consolidate assets with one advisor who can provide all of those services.
Jeng, anything to add?
Sure. I think one of the things that a lot of advisors, when they do financial planning, many advisors do planning, they do comprehensive planning, they do holistic planning, is that sometimes the clients view the outputs as sort of these concrete types of steps or goals or outcomes. And we have to remember that when you use planning software, it's a statistical software. It's not a planning software. The software does not give advice. It's not like the software stops in the middle of the Monte Carlo simulation and adjust their Social Security if the Monte Carlo starts to fail. That doesn't happen, right? So it's mostly a statistical software to give probability of success and failure. And it's really up to the financial professional to give that advice. And I think when we look at what we call dynamic income planning, is about giving the advice given the certain circumstances at the time of retirement. And flexibility is the key. When we look at how to adjust for risk, we don't know what's going to happen in 10, 15, 20 years. So whatever you decide to do, for example, you say my client's going to take Social Security at 62 or 65 or 66, and they're currently 52. Well, a lot could change over 10 to 15 years. So I think it's important to maintain that flexibility and do some contingency planning. I think that's the most important thing, is to have some contingency outcomes for clients. And so not having maybe one planning scenario, but a couple of different planning scenarios, depending on what happens with what happens during their lifetime and their individual circumstances.
Right. I know, and Anders, you'll know this well too. In the RMA program, we talk about two things. One is the need to monitor and constantly adjust the plan given changes in someone's facts and circumstances. And I'm fond of, when we use, for instance, in the RMA, the household balance sheet, right, creating a best case, worst case, and probable case, so that you're dealing with not just one outcome, but maybe a range of possible outcomes given the facts and circumstances.
Yeah, that's exactly it. You have to be able to address, both the best and the worst. So Monte Carlo is great, but those outcomes are going to be different. You need to be able to help a client prepare. And a lot of this really does come down to that client education. And that other element of the RMA program, the Retirement Income Policy Statement, is such a useful tool in that education process to address those different outcomes.
Yeah, we'll talk more about that in a second. You hinted at a second ago this notion of right products or right assets or right strategy. And I'm wondering, is it binary? Is it one or the other, or is it both?
Yes. That's the kind of the conundrum here, right? With income planning, is that it's having the right assets, but also having kind of that right approach. We talk about dynamic income planning, and we look at assets from a kind of a perspective of the correlated assets versus semi-correlated or non-correlated assets. But there's really, to your point earlier, that solution allocation approach also. And again, with the RMA, looking at that flooring, and then having a flooring allocation, a longevity allocation, a reserves allocation, and an upside allocation. That's kind of a solution allocation. And so many folks have grown up using modern portfolio theory and traditional asset class allocation. But that needs to be altered just a bit as you think about how you incorporate that and overlay that with that solution allocation, and consider how best to meet those needs. And again, from our perspective, right, we are focusing really on those flooring and longevity needs. As an annuity provider, we provide solutions that meet those needs very uniquely. So that's where we help advisors incorporate those into those portfolios that they may not have thought of or recognize opportunities to use those in the past.
You mentioned longevity. So when you think about the variables that financial professionals have to consider for the retirement income phase that are different from the accumulation phase, any thoughts about what those variables are?
The variables for for the asset?
For the FP to consider, yeah.
As far as the variables, lots of different variables, to consider when it comes to looking at risk management, so to speak, in retirement. There's the longevity concern. People are concerned about the money, not lasting as long as they do, and having the amount of income that they might want to have. But then also the issue of a sequence of returns risk, which everybody talks about, and being concerned about starting to take distributions at a time when the market could be going down, especially as we've been in a rather rising market for quite some time. A lot of folks are concerned about that risk, about that, starting to take distributions in the market going down. We're concerned about inflation. These are all fairly standard kinds of risks that people think about, and they're very investment oriented if you think about that, right? And that's that one approach, that popular approach, that investment approach. But you mentioned the household balance sheet, kind of that asset liability matching approach. And that's an important thing to look at too. People really need to take an accounting of what they have and what they project their needs to be. And just like a balance sheet, do you have the assets to address and meet those liability needs that you could have? But then there's also that third approach, which is the needs-based approach, kind of Maslow's hierarchy of needs, going back to our high school or college psychology class. Those needs to provide for that guaranteed income, for those certainty, that certainty that they need to have to meet those important needs that they have to pay for before they can look and pay for some of those want-to-haves, so to speak. So in income planning, we call it dynamic because it really is a combination of the investment approach, of that household balance sheet asset liability analysis, but then also that needs-based, and melding those three all together. And then, you've got unique things that people are going to be facing in retirement as well. Like cognitive decline, right? Had you take into account what might happen if mom or dad, gets dementia, right? And Alzheimer's, those are becoming bigger and bigger issues. What happens if there's a divorce? More and more folks are getting divorced, in retirement. My own sister got divorced after 32 years of marriage, right? I mean, it's becoming a more common thing. So as a financial professional, in talking to clients, bringing up some of these issues, folks don't think about this, right? They retire once, and then, they have to face all these things that they've never faced before, and it's all unique. So that's where they need the help of financial professionals so much.
Jeng, anything to add?
Sure. I mean, I think a lot of times financial professionals think of strategies. They don't focus on products because, they say, I'm not product oriented. I'm solution oriented, which is great. But if you think about planning, so much of planning and strategies depend on legislation, right? And things change all the time. I remember when I used to do Social Security client events all the time, and we used to talk about the payback strategy and file and suspend. And they've eliminated those type of strategies. Maybe net unrealized appreciation will be eliminated in the future, or whatever different types of tax strategies that people might employ, or income planning strategies. So to be able to make those type of adjustments and to help the clients make the type of adjustments, you actually need the right types of products and solutions. And I think a lot of times, maybe sometimes financial professionals underestimate the need for different types of retirement income products and solutions.
Mm-hmm.
A lot of times they think you just invest money in an advisory format or mutual funds or whatever, or I'll do bonds. It's not taking into account certain aspects of products, for example, annuities, that might help mitigate some of that risk and help mitigate some potential tax law changes or other changes by Congress. And the other thing to remember too is once a client is retired, they might live 30 or 40 years and not be able to generate any income outside of their investments or mitigate that risk. So I always think of it as though if someone's unemployed for 30 or 40 years, right? And it's sometimes difficult to make changes once a client's portfolio or their retirement income is set. So I think it's important to understand that the financial professional should position the client in a way that no matter what types of changes that Congress makes in the future, that their clients will be positioned to be able to still have that secure retirement.
Right.
But, Bob, just to kind of jump in though, you were talking about what the financial professional has to do for the client. It's all client focused and outcome focused, et cetera. But, the reality is it's really beneficial for the advisor to do this for their business as well.
Well, yeah, I'd love for you to elaborate on that, because in a world where advisors have to differentiate themselves from one another, and they have to demonstrate perhaps their value as this income planning specialist, is that right, fair to say?
Absolutely. Yeah. I mean, this was first identified, I think, about 8 years ago. David Blanchett at Morningstar at the time wrote an article about what he called Gamma. And he was able to really quantify specific elements of the conversation that a financial professional would have with their client that would help them make better decisions about retirement. And it actually added to the amount of income that they were receiving each year and throughout their retirement. Things around, their Social Security claiming strategy, which is obviously very common, but also their tax, the taxes, that they would make better tax decisions. They would make better choices around asset allocation, incorporating annuities into their, into their plan as well. So there are a number of different elements that he was able to quantify, and those advisors that had those conversations with their clients were able to add and demonstrate the value in that relationship. Well, that work has been replicated and carried on by other firms like Vanguard with their advisor Alpha. Envestnet did some research on this. They called it Capital Sigma. And Russell just this year came out with their research. And they showed that on average, an advisor was adding 4.83% to the client's portfolio. And all of that research really highlighted 4 key areas of service, right? Things that an advisor might do. It was financial planning, which we're talking a lot about here, portfolio management, which is that investment, of course, foundation, the tax management, which we know is enduring, but then also it's behavioral guidance. And the behavioral guidance actually seemed to be the largest contributor, right? So the biggest thing for a financial professional to do, especially in this income planning, is to help clients make better decisions and manage the behavioral side of that relationship.
Yeah, I've had a chance to interview some of the researchers at Vanguard about that research, and it struck me the notion that behavioral guidance is such an important factor in terms of what the clients value and what the advisors can do to demonstrate their value.
Very true. Very true.
So, you talked a second ago about moving beyond conventional wisdom. And I think what you've just hinted at is this notion of intellectual arbitrage, right? That you take this knowledge that you have and improve the outcomes to your clients. Is that what you mean by intellectual arbitrage, or is there something else that it means?
Arbitrage, right? So arbitrage is where you can make make incremental benefit, right? Incremental gain on the edges, and that really is what we're talking about. Any advisor could be out there talking about the very conventional strategies for planning for retirement income. Well, we're going to use the 4% rule. I'm going to maybe use the bucket approach, and you'll be fine, right? We'll check in, we'll do a 60-40 allocation, and you should be fine. But the reality is, you're going to have much better opportunity by looking at things in a unique and in a different way. And that's what we mean by intellectual arbitrage. Helping advisors find their unique opportunity to serve their clients in a way that will help them achieve their goals, and it helps the advisor to continue to grow their business as well, because they'll be able to communicate effectively what they do and the clients that they do it for, right? So they can really target a certain client base and the services that they can provide to them, and by doing so, garner much better client relationships and larger share of wallet, which is what a lot of folks are looking for.
Jeng, I'm certain that you have more to add to that as well.
Sure. I kind of think of intellectual arbitrage as an inefficiency, right? Arbitrage really means that there's an inefficient market, that there's something to exploit, that an efficient market, it doesn't exist. And if we think of the market, we think of it as being efficient. But if we think of advisors or financial professionals and the advice they give, that's not efficient, because some advisors just give, or some financial professionals just give better advice. And I think that's the inefficiency, and the ability for the financial professionals to stand out amongst their peers is that intellectual arbitrage. So, for example, if you were a client and you want to have a holistic retirement income plan, you might want to have the financial professional understand Social Security or how Medicare works, because that's a big part of their retirement. Medicare is the central block of healthcare at retirement. So it doesn't mean that financial professionals have to be an expert on it, but that differentiator could be that they understand Medicare and how it factors into the retirement planning scenarios, or tax strategies. You might not give tax advice, but if you understand tax strategies, that could be a value differentiator. And I think there's so many different areas where some financial professionals are fluent in. Estate planning is another one, right? And all these different areas of financial planning that many financial professionals don't touch. Maybe they just focus primarily on investments. And I think that's where the arbitrage is, that there's an inefficiency in the advice that's given, that if the financial professional can get up to speed on some of these, I think it would differentiate themselves from the competitors, especially in this fee compression type of environment where people could literally trade stocks and equities for free. That's, I think, going to be more and more important going forward versus like a robo advisor that just puts you in an asset allocation portfolio.
Yeah. So as I think about the knowledge required to create this arbitrage, obviously folks like Michael Kitces has written about this, and what he and others have written is becoming more sophisticated in terms of the approach to retirement planning. Anders, talk a little bit about your thoughts about what Kitces has written about with respect to the methods for retirement income planning.
Yeah, the methods, which we alluded to a little bit earlier, right? You got the curve, the triangle, and the square, the rectangle. It's as much art as it is science. Each client situation is unique. They have different needs. They face different risks or different concerns. And their portfolios are unique, how they're structured, the types of assets that they have. And so the real good folks that are doing retirement income planning understand how to meld that income approach or the investment approach from a portfolio portfolio construction, asset allocation, right, which is important from an investment perspective, but also layering in what their assets are, looking at where those assets are reside, what the sources of income are going to be, and how best to distribute those to minimize taxes. And they're planning for those things in advance. It's not as though they're coming at age 65 and saying, okay, now we're going to reallocate those assets. That wouldn't be practical. So they're planning for those starting in their 40s and 50s, of course. But then also addressing the unique client needs and creating that structure of the portfolio that's needs-based as well. So, again, with Michael Kitces in that article that he wrote, and I think there are others that have written similarly about this, that it's a combination of that the curve being modern portfolio theory and the efficient frontier, that needs-based with the triangle, and looking at specifically what unique issues a client may be facing, and then taking into account where those assets are, and then getting them positioned in such a way. That's why we talk a lot about Roth conversions, right? And taking advantage of those now while we have them. And it's not just the traditional Roth conversions, but like the mega backdoor, right? The opportunity to take retirement plan assets and convert those a much larger amount, create that, especially for those high net worth clients. So, lots of things that are happening from a tax perspective that may cause us, especially over the next few months, to be able to make some changes to a client's portfolio and incorporate unique strategies to meet the client needs,
right?
Both accumulation and income.
Yeah. So when I think about, I might call me a nerd, I don't know, but I like thinking about retirement risks, and I like thinking about the principles of insurance to address some of the risks that you'll face in retirement. whether it's pooling or hedging or diversification. And to me, it's kind of interesting because while financial professionals have long thought of those principles of insurance for maybe property and casualty, they may not have thought about their use and value in retirement income planning. Talk a little bit about those risks and the strategies that can be used to mitigate or manage those risks.
Well, exactly. One of the biggest concerns people have is longevity risk and money lasting as long as they do. And so by pooling risk, by looking at a large number, the law of large numbers, right? So from an insurance company's perspective, they can provide a higher level of income by having a larger pool of investors or of individuals. And so pooling the risk for to meet that longevity issue is incredibly efficient, and it allows advisors or financial professionals to talk to their clients about ways that they can provide more efficient income. Right, and this is where annuities fit so well, especially those that have the guaranteed living withdrawal benefits, where they can provide for higher levels of income, potentially 5, 6, even in some cases 7%. And that's much higher than you might be able to get on a guaranteed basis, right? It's going to be guaranteed income or secured income for as long as they live, because you can pool and you lay off that risk to others. And then you can manage, and this is again goes to the education of the clients for the financial professional, differentiate themselves and talking and educating clients about their strategies for mitigating the risks that they're concerned about. There are a lot of different risks that they're going to have to face, and the advisor, the financial professional, can share with them their strategy for each of those risks. They can obviously build a greater level of trust, and that's why we've created worksheets around risk assessments to talk through the specific risks that a client might be concerned about and the impact that it could have on the portfolio and for their individual situation, but then also the strategy for the advisor or the financial professional to utilize to mitigate that particular risk.
Yeah. When I think about the use of annuities and the principle that you mentioned around pooling, the concept that sometimes I think gets lost on financial professionals is the notion of mortality credits and the value that those credits bring, especially when you think about it relative to maybe, say, a traditional investment portfolio of stocks and bonds, which don't have mortality credits.
Right. True. Absolutely. So that makes a big difference. And again, it's what the unique aspect. It gives the ability for a financial professional to provide, again, that certainty and the flexibility for them to actually be better planners. Right. And we've talked a lot about planning, and that's such an important part of all of this. And that's where annuities can really fit in.
Yeah. I often, I'm fond of noting that a general contractor or carpenter would never show up at a job with just a hammer, right? They'd show up with a toolbox filled with the right tool for the job that's required. And so for a financial professional to show up for a job with an incomplete set of tools, that doesn't necessarily help the client at the end.
Exactly.
So let's talk a little bit more about Delaware Life's products and the features and how they align with the income planning focus.
Sure. So, the products, again, like any variable annuity, some of the real key benefits of incorporating annuities into the retirement income planning process is the fact that we do have income features available that do allow for higher levels and certainty of income in the future. That certainty of income. So you could have guaranteed growth with a guaranteed living withdrawal benefit in our products. And that income could be paid out at a rate that's generally higher. Like at age 65, it could be 5%. Most folks think about the 4% rule. So if it could be 5 or 5% or even higher, potentially, that provides that certainty of income. So that's important. It's the downside protection that we can provide as well. The ability to have investments in the market where you have the opportunity for some growth. And you could have a variable annuity where you would utilize any number of very well-known, high-quality managers, but know that you do have some downside protection on that as well. And if you're even planning for income, you can even have guaranteed step-ups over a period of time. Obviously, from an accumulation perspective, the tax deferral aspect of an annuity makes a lot of sense. And then, again, back to the behavioral part of it. Right? Annuities help from a behavioral guidance standpoint because they are by design long-term investments. They're meant to be held for a period of time. So it forces clients oftentimes to hold on to investments that they might think about selling if it was in a different kind of an environment. That it helps them to stay consistent, and if they in fact they do want to make a change, well, they can, and it doesn't have the tax impact, so they can do reallocation and rebalancing as they wish. So a number of ways where our products would fit into that income planning solution. And Jeng, I don't know if you might have any other thoughts you might want to add to that as well.
Well, I mean, that's part of sort of our dynamic income planning strategy, is to have very different types of asset. People always talk about asset allocation, but a lot of times when you think of asset allocation, it's about different asset groups or asset classifications: large cap, small cap, mid cap. And we know in a down market, in many situations, all of them fall, right? Whether it's large cap, mid cap, small cap, international, growth, value. It's just a degree of how much they fall during bear markets. So I think it's for many financial professionals, we have to kind of look at how do you transfer that risk and have different types of investment vehicles rather than different asset classes. Because in asset classes, they may all fall, but if you have different types of investment vehicles, they don't all fall. And I think that's what we want to focus on. I think that's where the annuities could really play a strong part, because in the rising market, annuities also participate in sub-accounts that will also rise. And in down markets, what you could do in many annuities is you could turn on a lifetime income. And that helps you mitigate that risk, because that many times the income is guaranteed. And so what happens is now the account value starts to fall, but then financial professionals could turn on the income for their clients. And that's what we talk about, is that annuities are semi-correlated to the market. We know obviously stocks are 100% correlated to the market, and Social Security is 100% not correlated to the market, because you're going to receive that no matter what the market does. But annuities helps fit that void in between. Is that if in a rising market, it works. It could also appreciate. In a down market, it creates lifetime income. And so we call it semi-correlated. And that's part of our dynamic income planning strategy.
And, just to tag on to that, you mentioned the different sub-accounts, especially the equity sub-accounts. Dalbar's study just recently came out. And from a behavioral standpoint, I think this is where this fits in. But from a performance standpoint, it also makes sense, because what that study showed is that investors in VA sub-accounts ended up staying invested longer in those sub-accounts, even through different and difficult market times, but then also have actually outperformed their mutual fund counterparts over 1, 3, 5, 10, and 20-year time periods. So the benefit of staying invested. And so for clients looking for accumulation, then obviously then for distribution, to Jeng's point about being able to take that, perhaps if there is a down market, this is a semi-correlated asset. You might want to get that guaranteed income from the annuity as opposed to another investment type or investment vehicle where it could be down.
Yeah. Anders, I think I mentioned before, I spent 7 years at Dalbar and was part of the original team that created the quantitative analysis of investment behavior. It's
Very
a
good.
proud moment. Still going. I'm glad to see that.
Yes, sir.
The two things that were triggered as you were chatting. One is the notion of what Moshe Milevsky had created years ago, which you referred to as product allocation, and sort of it was the evolution of asset allocation to the notion of incorporating financial capital with products to create the optimal income plan. Any reaction to that in terms of how what you're describing fits in?
Well, I think it's the evolution, right? I mean, we continue to evolve. This whole area, it's growing in need, it's growing in knowledge. There's many advisors are now starting to spend more and more time with their clients on income planning. Well, both because their clients are getting older. And it really is becoming a client need, but it's just the natural progression. A lot of the advisors and financial professionals are getting older, and their clients are growing with them. So all of that research, Moshe has done a terrific job, especially on a lot of longevity research, et cetera, that he's done as well. And so we'll continue. That's again why we're so excited about our Income Planning Institute and the resources that we have, because we're continuing to identify new ideas, new strategies, ways to incorporate some of these concepts. And there's all different types of approaches, and because each client is unique. So we try to be kind of that sounding board, right? We work with thousands of advisors. And so, we try to kind of glean best ideas as best we can and share them with others as we find them.
Yeah. So speaking of best ideas, there was another piece of research that came out recently from Michael Finke and David Blanchett that looked at annuities and their ability to give permission to spend and be happier in retirement. I'm sure you saw this research. I thought it was again expanding the body of knowledge around the use and value of these products.
Exactly. Yeah. Well, it goes to having that certainty, right? If folks are, if they're confident, if it increases their confidence in their ability to have income throughout retirement, not having to be concerned that they're going to run out, they're going to be happier.
Yeah. Talk a little bit. We know in the world of some financial professionals, they communicate and deliver an investment policy statement to map up against someone's investment plan. In the world of retirement income planning, in the RMA, we talk about the use and value of a retirement policy statement. Care to talk a little bit about that?
Well, I think it's a terrific tool. It's a terrific idea. It is a unique element of the overall financial plan. You have, the overall growth plan, right? The accumulation plan. You have the income plan, and ultimately you're going to have an estate plan, right? And how you're going to be passing these on. So these are all intertwined. In fact, the income policy statement becomes the communication vehicle and the link between the financial plan, perhaps, and the estate plan. And so it's a very important piece of the puzzle, and it's the opportunity to incorporate, whether maybe you use a technology service, right? You use some Money Guide Pro or whatever it may be, and they have wonderful outputs that you can share, but they're very they're not that customized, right? And so what we talk to a lot of financial professionals about is, yeah, that's fine, because that gives you that kind of static one-time look, but customize it, right? It needs to be dynamic, right? Put your spin on it and how it could evolve and change, and use that as the foundation for that ongoing conversation with the client, but also with their beneficiaries, because then that steps into the whole estate planning part.
Yeah. Jeng, anything to add?
Yeah, I think a lot of times, I used to deliver a lot of financial plans. I used to work with financial professionals, and when I used to do fee-based planning, and we would charge clients fees to do customized plans, I would help deliver those plans and have that conversation with clients. And what clients really want to hear in many situations is that the financial professional is going to be there for the long haul, right? And that's what's really important for them. They know that these numbers that's presented in front of them, these Monte Carlo analysis and these probability results and these wealth transfer numerical studies, it's static. It's what it is today. It's not what it is going to be 10 years from now. It's not going to be what it is 15 years from now. It's not going to be what it is 20 years from now. And I think many clients they don't always go for the highest returns, because that's not what's most important to them. What's most important to them is that they need to feel confident that their financial professional understands the strategies throughout the retirement process, that they can make adjustments as necessary, and that they could help guide them through the process. And that's why we always, and going back to the intellectual arbitrage, this is why it's so important. A lot of times financial professionals will use the term the quarterback of the financial planning process. But are they really? To really be the quarterback, you have to have a lot of skills, right? And I think it's important that financial professionals evaluate, are they strong in all those areas? Are they strong in estate planning, or are they strong in retirement income planning? Are they strong in tax strategies? Are they strong in government benefits entitlement programs? And if they're not, is that really important to their clients? Maybe it's not important to their clients. Maybe they just tell them up front, like, I'm here to do your investments for you. And then you find somebody else, find an attorney to help you with this, and find a tax professional to help you with that. But I think it's important to have that conversation on what you can and can't help them with. But if you do say that I am here, I could do all these things, then maybe it's important to shore up some of those areas, and we could help with that if if they need some.
Yeah, I'm always fond of saying comprehensive means comprehensive. If you hold yourself out to be a comprehensive planner, that means one thing.
Can't hide from that.
I do everything but that. You've hinted at, but we haven't talked enough about some of the educational programs that you offer with respect to dynamic income planning in our conversation today. Care to do a little bit of a deeper dive on some of the things that advisors can avail themselves of?
Yeah, absolutely. Well, a couple of years ago, as we were considering, how best to approach the marketplace, we created what we call our Delaware Life Income Planning Institute. And it really is the warehouse for all of our resources that we've created to help financial professionals and their clients address this issue of income planning. These are all educational type of pieces that we provide. They are white papers for financial professionals to read, to get better versed, more knowledge around specific areas, but then also client pieces for them to have conversations with their clients about those topics as well. And then we have client workshops that we provide. So it's that three-step process, right? Helping the financial professional understand an issue or an opportunity. How then can they have that conversation? And then how do they present that to the client with a client workshop? Also, I mentioned, we talked about the value of advice a little bit earlier. We've got a piece that we've just written on that specifically. It's available on our website. And it's called the value of advice, differentiating and defining and demonstrating the value of your advice. So we have those types of practice management resources as well for advisors as they're considering, how best should I move forward? How best do I grow my practice? How do I get to the next level? How do I increase my assets under management? And we have worksheets for clients. We talked briefly about the risk assessment worksheet, right? It's a very useful tool to have that detailed conversation, but we also have what we kind of call in our own vernacular, kind of about a 15-minute income plan. And it's really the opportunity to help a client understand some key issues, but then look at their spending and identify a potential income gap between what they might be receiving from a guaranteed income or secured income perspective to what they might need going forward. And that's been a very popular tool for advisors as they're thinking about that conversation with their clients. So all of those are available at the Delaware Life website, www.delawarelife.com. And again, we also provide workshops that we can deliver, continuing education workshops or just informational workshops on any of those topics as well. So that's what our team does. Jeng and I both are on the National Sales Consulting team. And that's what we do in conjunction with our wholesalers to deliver those kinds of resources with our wholesalers.
Yeah, I also like to add one more thing as well. A lot of times when we look at it, and financial professionals often have a very difficult job, is to take a look at the data that's presented in front of them and then come up with strategies, right? And the software is just the input of what the advisors want to be there. So one thing that we help many financial professionals with is what I call the financial planning decision tree, is to expand to be able to expand their knowledge, to be able to do combination strategies. And I think that's so important. So for example, if someone says, should I convert my Roth IRA, traditional IRA to a Roth IRA? So a question I have would be, well, are you going to live in the same state when you retire? If you move from California to Florida and you convert the Roth IRA when you still live in California, you might pay 13% more on that Roth IRA. And if you're 63 years old and you convert a giant Roth traditional IRA to a Roth IRA, and for some reason have a blip in your income taxes, that could affect your Medicare premiums. Medicare is the same coverage, but Medicare premiums are depending on income. And if you convert at the wrong time and suddenly have a large income for that one particular year when they assess your Medicare premiums when you're 65, that could be disadvantaged. That could be not the right strategy. So when we think about things like that, there's so many different aspects of income planning that we want to incorporate, whether it's state income taxes, federal income taxes, government benefits, Social Security, Medicare, and to be able to incorporate all those and expand that financial planning decision tree when you spot an issue. It's about issue spotting. And this is something that's very taught in law school, is to be able to spot issues quickly and to understand all the potential variables that might affect the client. And that's something that we also help in the Delaware Income Institute.
Yeah, such a vital aspect because it's easy, I think, to overlook the downstream effects of one action. And so having this notion of looking at the combination effects and the downstream effects is really important, especially because clients' money is at stake, right? Taxes are at stake.
Everything, exactly.
Yeah. So we've covered a lot of ground. Anything that we missed or anything that we've already addressed that just bears reemphasizing?
certainty of income, right? Providing for clients, helping them have the retirement that they're looking for, and helping them achieve their goals requires, as we've talked about, that comprehensive approach that has to be dynamic in nature. You can't hide from is this a word? Comprehensivity. being comprehensive. And that's what we're here to help financial professionals do that and do that for their clients.
All right. Let's give our listeners, a preview of what's coming next in our next podcast.
So next, we'll be talking a lot about Social Security and what that's going to be entailing in terms of making the right decisions from a claiming perspective, but also strategies that may be unique for unique situations for spouses, for children, et cetera. So there's a lot to cover, a lot of different nuances and areas of interest where advisors can continue to differentiate themselves. It's a topic that's been around. It's a popular topic that always comes up whenever you go to or listen to a conference, whatever it may be, because there is a lot that can be done there. So we'll be chatting about that next time.
All right. Anders, Jeng, thanks ever so much for joining us on the Exceptional Advisor podcast series.
Thanks, Bob.
Thanks, Bob. Great to be here.
Thank you for listening to our podcast today. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org. For more information on Delaware Life, visit www.delawarelife.com.